Good evening and welcome. You're watching NDTV Profit, and the big story that we are tracking today is mutual fund SIP inflows that seem to have surged 10% to cross 23,000 crore rupees for the first time now. SIP, of course, stands for Systematic Investment Plans. The Association of Mutual Funds in India, or AMFI, which tracks this, has released the July data for the industry. To discuss this in detail, we are now joined by Mr. Harshvardhan Roongta. He's the Chief Financial Planner of Roongta Securities, and Mr. Vishal Dhawan, the founder and CEO of Plan Ahead Wealth Advisors. Good evening, both of you, and thank you very much for joining us. I'm going to ask you to be a bit patient because we just want to run through the numbers that have actually come in. And to give us more context, Alex is joining in with this report first.
Well, the big number to focus on, of course, is the SIP inflow number, once again hitting a record high in the month of July. 23,300 or thereabouts is the number. And it's interesting to note that the SIP gross inflow number has hit an all-time high every month since July of 2023. And that is a testament to the tenacity and the interest of the Indian investor. A few other numbers stand out here. And there is a significant inflow into mutual funds in the month of July. This is to the tune of about 1.9 lakh crore rupees. Of course, do remember that this is the start of a new quarter, and as a result of that, you have a significant inflow in the form of fixed income mutual fund schemes, and that stood at about 1.2 lakh crore rupees. The more interesting stories are emerging in the actively managed equity mutual fund space, where once again you have a substantial inflow to the extent of about 37,100 crore rupees, a bulk of them once again coming in the form of inflows into sectoral and thematic funds. After having received 40,000 crore rupees or thereabouts in the months of May and June cumulatively, once again in the month of July, it's received inflows of 18,386 crore rupees. And that has taken it to the largest category in the actively managed equity mutual fund space. And the assets under management stand at 4.21 lakh crore rupees as of the end of July. You have inflows into small cap as well as mid cap mutual fund schemes, and also some inflows into large cap mutual fund schemes. But interestingly, you're also seeing inflows of over 8,000 crore rupees into index funds. All told, the mutual fund sector as a whole will be happy with the inflows, and well, another great month for the sector as a whole.
All right. Now, Mr. Roongta and Mr. Dhawan, thank you very much. It's good to have both of you on the show. Mr. Roongta, to begin with, what do you make of the SIP data that is coming in? And we seem to be hitting record highs. In fact, we've seen this number go up consistently. What do you make of this trend?
So, well, if you look at the historical patterns, okay, you will see that when the markets generate an excessive positive return, you'll find new investors coming in trying to chase those returns. So not complaining about it, but nevertheless, you must understand that the popularity of the product, which is investing into mutual funds through SIPs, the systematic investment plan, the kind of returns that investors have experienced in the last 2 to 3 years has only encouraged and motivated themselves to increase their SIP, and for those who were sitting on the fence to start investing into SIPs. Another reason possibly is because of the lack of alternative investment options. So if you were to look at any other alternative investment, such as you may look at, say, probably a fixed deposit or a post office deposit, those returns are, of course, muted and they don't tend to beat inflation. The awareness that has been created around investing into equities for long-term via SIP, I think all that is playing about right now. And yes, of course, I mean, primarily focusing upon the returns that investors have generated in the past, they seem to allocate more towards SIPs now going further.
Right, Mr. Dhawan, any opening thoughts that you have on this? The numbers, as I was earlier saying, seem to be consistently going up. What do you think this trend is actually suggesting?
So clearly there are some good things about this and some not so good things about it. Let me start off with the good things. I think the discipline that investors need with ensuring that some part of their money gets saved and invested is something that is a very, very positive trend, because traditionally, you would always say that Indians are great savers, but they aren't good investors. and the money used to lie around in a savings account very often, just waiting for something to be done with it. The fact that there is now an automated, disciplined method of that money going away through an SIP into mutual fund is probably meaning that it's a great way to ensure that the discipline continues. And very often, it's a forced saving habit, which is very, very good news. The second thing which has happened is that we need to keep in mind that the last 1 year has been a combination of two things. One is markets have generally gone upwards, but there has also been some volatility along the way. There has been news flow coming in either internationally or from how the elections panned out or other reasons. But fundamentally, the flows have continued to come in irrespective of that. And I think that's also good, that probably it's indicating that some amount of the behavior is becoming more mature of retail investors as compared to what one has seen in previous cycles. I think the not so good news is that clearly everyone's buying with their eyes in the rearview mirror. And I think a lot of the expectations of returns that are getting set from the more recent performance. And this recency bias could actually come back to hurt all of us because, when the returns start getting muted, which is very normal over long cycles, I think you need to be able to see whether investors continue with the same way or not. The second not so good news is that the gross flows versus the net flows always show slightly different numbers. And therefore, it means that a lot of the money that is actually going into SIPs could also be redirection of money from earlier SIPs going to a particular type of scheme to now going into a different type of scheme. And therefore, one would want to keep both of these things in mind as well while sharing the good news around SIP increased flows.
Absolutely. Now, the data seems to suggest, Mr. Roongta, that sectoral and thematic funds are the new buzzword. Now, investors appear to be chasing these hot sectors and themes. Do you see this as a healthy phenomenon? Or would you recommend what would you recommend to new investors vis-a-vis perhaps more seasoned investors?
So, well, in fact, this increased allocation towards sector and thematic funds is actually a cause of concern. There are two reasons for this. One is, of course, all the fund houses have been mandated by SEBI to have only one scheme in the particular category. So if they have a scheme in the large cap category, they cannot launch any other scheme in that category. So there is a limitation of having one scheme in each. So large, mid, small, multi-cap, large and mid-cap. So all these particular segments have one scheme that they can allocate towards. Now, when it comes to sector and thematic, so the definition of a thematic fund, can be twisted, can be modified to make anything and look like a theme-based fund, and a new fund can be launched, and there is apparently no such limit over there. So you will see the kind of launches that are happening these days through mutual funds is essentially towards the thematic and the sector funds, trying to garner and capture the AUM from the investors, projecting to be the next best theme or the returns, the potential for higher returns to be generated in a particular theme or sector, which apparently the retail investor does not really, be able to distinguish between. So I think this is a very large cause of concern to me, that if a retail investor is coming into the market, he's better off investing into diversified funds, say in the large, mid, or the small cap category for that matter. More particularly sticking to the large and mid cap category and avoiding the small caps if you're a retail investor. So I think this is a cause of concern, and this could, as Vishal also said, could backfire on all of us, wherein the expectations that the investors are generating or expecting out of these kind of investments are exponentially higher than what normal averages would be, long-term averages would be. So I think a word of caution to all those listening in, please be very realistic about how equities will perform. What has happened in the last 1 or 2 years need not replicate itself and generate the same kind of returns in the future. So I think this is a very serious cause of concern, and probably, and I'm hoping good sense prevails over investors and they move to diversified funds, particularly in the large and the mid-cap categories.
Right. Mr. Dhawan, do you share these concerns? And should investors be aware of certain red flags as far as this is concerned?
Most certainly, I think to supplement what Harsh was just mentioning, there are two things that tend to happen with sector and thematic funds. One is that um, very often there are narratives that are built in, which are independent of the price of the sector itself. So, what could happen is you could have a particular sector that has a great outlook, but the stocks in that sector could have already run up very significantly. Now, what happens um, in a actively managed fund, which is, for example, a flexi cap fund or a multi cap fund? The manager of that fund is making decisions on which sectors or themes look attractive vis-a-vis something else, and therefore they're taking that decision first, and then within that they're allocating money to specific stock ideas that they may like, or maybe exit ideas that they don't like. The moment you buy into a sectoral or thematic fund, you have actually taken on that primary decision yourself as an investor, saying that I know where and which sector I want to go to, but I'm going to leave the stock selection to the manager. And I think that's probably the less important job that you're doing here. And therefore, it's very, very important to keep in mind that you have that ability at all. And more importantly than just getting in, it's also about being able to get out on time. Because if you buy into something which is a great opportunity, but it gets too expensive and then it falls off a cliff, which historically we've seen with multiple themes in the past. You have to go back to IT funds, in the 2000 period. You have to go back to infrastructure in 2007. And there have been multiple such cycles that have come up. So I think investors going to thematic funds or sectoral funds seems to sort of belly normal logic. And one would want to be very careful there.
Right. So, in a sense, you think that they must have full information before they actually go into this. I want both of you to focus now on hybrid funds. Now, we are seeing quite an uptick in these numbers. Why do you think we see this uptick? And of course, there is the point that long-term capital gain tax on these funds have been drastically reduced to just about 12.5%, offering a substantial tax advantage. Do you think that is part of what's making it a little more attractive? Mr. Roongta, perhaps you could go first.
So, well, with regards to hybrid funds, I mean, one must understand that it solves two purposes. One is, of course, those people looking for asset allocation. So we have many investors who are coming into the market right now, not comfortable with allocating the entire money towards equities. So there is an element of adding some debt into it, or multi-asset commodity kind of a thing, where you have even precious metals coming into it. So it does work as a means and a medium for asset allocation. And the other part is when you have a hybrid fund, say, for example, which invests up to 65%, or rather minimum 65% in equities and the balance in debt, you will see the rebalancing happening at regular intervals. Like, for example, I mean, if the equity markets have run up and the equity allocation in that fund goes up to, say, 75 or 80%, where the fund manager will automatically rebalance this and bring the equity component down. So just to make sure that the allocation is, say, 65 to 70% in equity and the rest in debt. So it does solve that particular purpose. And it does, satisfy the investor to that extent, saying that, okay, fine, he has not put everything into equities and there is some element of debt. Now, looking at the debt allocation as well, I mean, going further, if not immediately, as RBI has not reduced the interest rates, but we do see that interest rates in the coming quarters, there is a possibility of cooling down. So there could be some kind of exceptional gains to be made in the debt allocation as well. So yes, I think it's so there is absolutely no doubt on that part. It's a particular category too, which is here to stay, and it's a very good option for investors looking for all kind of allocation. So you have hybrid funds which invest as little as, say, 25 to 30% in equities, and as much as about 80% in equity. So you have the entire gamut for investors to choose from as per their risk appetite.
All right, Mr. Dhawan, do you share that view?
Absolutely. So again, from a taxation perspective, I think it's a very, very important point that you make. The interesting part that happened in the budget announcement a few weeks ago is that all of a sudden, by equalizing tax rates across equity and hybrid categories, which have more than 65% equity exposure, you had a point where suddenly decisions around where you want to invest would not have been driven by tax anymore and were driven purely by what is the construct of the underlying asset class. And this wasn't restricted to just hybrids, but even gold, even international investments. A lot of them have been beneficiaries of this process. And all of a sudden, what happens to investors is they can now go out and make certain decisions on their investment portfolio based on the merits of the asset class. What is their time horizon? What's their risk tolerance? All of those parameters now become all of a sudden very, very primary, which they should be, rather than the tax differential that exists between one asset class and another. So I think tax has been, while it's not got reduced as a percentage, I think this equalization model has actually probably helped investors, and I think it'll help going forward as well to make decisions easier for investors. Coming to whether, sorry.
Please carry on.
So coming to the second part on, is this a good trend? We think it's actually very healthy because a lot of first-time investors, when they're first experiencing equities, may not be comfortable with the kind of volatility that equity demonstrates. Clearly, when markets are going up, volatility worries people less. The problem happens when you go through periods where markets don't do well. And I think the cushion that hybrids can provide, and the fact that for a lot of investors, their experience can be better managed through a combination of debt and equity, probably makes it a good place where investors who even don't necessarily have the greatest experience because markets don't behave well, still end up becoming long-term investors because their overall experience is fairly comfortable and the volatility is controlled.
Right, one thing that's been very, very hotly debated everywhere is these new fund offers. They seem to be attracting a large number of investors, and while they may have rewards, they do also seem to have high risk attached to it since they don't really have a track record. What is your advice to investors? Mr. Roongta, you could go first, and then, the same question to Mr. Dhawan as well.
So, when any investor looks at a new fund offer, something that they have to evaluate very carefully is that scheme offering you something which the existing fund houses are not offering already? So say, for example, you're investing into a business cycles fund. You must evaluate whether there is a business cycles fund already available in the market, which has been in existence for probably 5 to 10 years, where there is a track record, etc. So what is the reason for you to apply in this new fund offer? So if you have a clear answer to that question, only then would you invest into that NFO for that matter. Secondly, you have to also evaluate whether you really require that new fund offer or whatever that scheme offers, whether it's a sector fund, a thematic fund, or any other fund for that matter, whether that scheme has any relevance in your portfolio. All you may already be having about 7 to 8 schemes which are fulfilling all the requirements that you have. So then what is the reason for you to get lured into a new fund offer? And more often or not, people are misguided with the norm that you're getting at 10 rupees NAV, so it is cheap. Well, this needs to be re-emphasized again and again that new fund offer does not mean, and if the NAV is 10 rupees, does not mean it is cheap. The funds, the money that scheme will collect, will get invested into stocks at the current market level. And so is an existing scheme that you're already investing into, or any scheme which has been in existence is 10, 20 years. They will also be buying into the same stock market in the same companies at the same current price. So this 10 rupees misnomer or a misguidance that investors have needs to be sorted out again and again. Another thing that they need to be very specifically careful about is that do not just go with the fact that there's a new fund offer, it has a limited time period until which you can subscribe, then will open up again. I think it's been very poorly constructed in the minds of investors to believe that this is an option for you to get something at cheap and something which is not available. So I think there needs to be very clear thought put into this. Unless there is something very compelling and does not exist already, there is absolutely no reason for anybody to look into NFOs.
Right, absolutely. Mr. Dhawan, so, as Mr. Roongta was pointing out, you should know the reason why you are entering this. Just because it's easier on the pocket should not be the reason. Do you agree with that?
Absolutely. I think, all the points that Harsh mentioned are absolutely true. I think there's just one parallel that I want to draw in, and I think that comes from the IPO market. For a lot of investors, they've traditionally confused an initial public offering on the stock market side with a new fund offer on the mutual fund side. And they've actually believed that, they're actually very similar. And you will see very often that uh, there's a very high correlation between IPOs being a very favored place for investors to invest in the stock market and new fund offers on the mutual fund side. Uh, the fact probably remains that both of them are not the right time for investors to come in. In the case of IPOs, that's a time where promoters are diluting stake. Very often, they want to get the best price. That's the promoters, and they're selling it out to investors out there. Similarly, on the new fund offer side, the fact is that the only thing that's new is probably the fact that it hasn't existed before with its own name in the way that it is, but it's existed elsewhere in a very similar format most often. And therefore, it's not really, really new in the way that people go about thinking about it. So I think investors need to be very balanced. If there is a very robust portfolio that's already been created and something truly comes in, which is unique, differentiated, um, has some way for you to validate some sort of a track record indirectly, I think you may want to look at it, but otherwise not.
All right. So very valuable points coming in from both of you gentlemen. Thank you very much for joining us this evening and clarifying some of the myths that surround this. Thank you.
Thank you.
Well, it is time for a very short break, but do stay with us on NDTV Profit as we bring you more on the other side of the big story.